Windstream has been picked as the focus stock of the week. Joining me in the studio is S&P Capital IQ equity analyst Robert DeZigo to tell us why he has a strong buy recommendation on this stock. Robert, welcome.
Good to be here.
So, can you tell me a little bit about this company, the history, and what they do?
Sure. Windstream's a telecom services provider. They're about a $6 billion annual revenue company, and they're in the S&P 500. Historically, they were a rural provider, providing internet and phone services to rural communities, to mostly to consumers. And they built the business by doing acquisitions over the course of several years, buying smaller properties, levering up, taking some synergies out of the business and getting the leverage back down again and producing cash flow. By 2008, 2009, though, I think they saw the writing on the wall, and they saw that cable competition was coming in because the cable providers were given the rights to do voice services. So cable voice became a big competitor to them, started taking some subscribers, and then the wireless business also started taking some subscribers away as people just dropped their landline phones and basically go to wireless. So what they did was they went on a little bit of a shopping spree in 2010 and 2011, and they acquired a bunch of telecom services providers that focus solely on business services. And those companies have great assets in fiber, data centers, sales, engineering teams, as well as just customers. And this transition kind of changed the company from a company that in 2008 about 40% of the revenue was coming from business services and broadband, which are the growth engines, and now that's at about 71% at the end of the first quarter in 2013, and that number is only going to get higher as that business continues to grow, and the 30% of the business, which is still the rural phone and the wholesale business, is continuing to decline.
Windstream has the highest dividend yield in the S&P 500. How sustainable is this yield?
We think it's very sustainable. Now, at 12% dividend yield, clearly it's a topic of conversation, and clearly there's concerns about it. But first of all, the management team has committed to this dividend. They paid this $1 per share annual dividend for many years now, and they've said on many occasions that they're committed to doing this. Now, they're paying out about 65 to 70% of their free cash flow is being used for this dividend after capital expenditures, which we think leaves enough cushion. If the numbers don't come out exactly the way we think they will, we still think there's enough cushion. And you throw into the fact that the economy is starting to recover a little bit, and with their focus on the business services, we think that gives them an extra cushion. So while yes, there is a 12% dividend yield, I think it's really less of a question of can they pay the dividend, but the question of will they pay the dividend. And the company's made it pretty clear that they want to continue to return this $1 per share to shareholders.
So how do you sort of touched upon this, but how do you value Windstream, and how does it compare to its peers?
Sure. We put a $10 target on the stock. It's trading at around $8 today. So coupled with a 12% dividend yield, it's a pretty healthy one-year return, we think, in the stock. We look at it on an enterprise value to EBITDA basis. Stock is trading below 6 times EBITDA on 2014 numbers. Its peers are trading above 6 times. We think with the little bit faster growth that we expect from Windstream versus its peers, plus the higher dividend yield, plus higher earnings growth, we think the stock deserves at a minimum to be trading at the same level as its peers. And we would put that same 6.2, 6.3 times multiple, and that gets us to around $10 a share. On an earnings basis, the stock's trading at around 16 times earnings today. The group is at 15. It's growing earnings faster than the group too. So we put a 19 times earnings multiple on the stock as well on 2014, and that gets us also to the same $10 price target.
So let me ask you this. What are the top reasons to buy the stock?
There's really 3. It's the free cash flow, it's the dividend, and it's the attractive valuation. Now, this is a company it's a very steady cash flow business. This isn't a company that has big waves in their cash flow. It's a rural community where there's less competition. They're losing customers at a much slower pace than some of the bigger carriers today, some of their bigger peers. And so we think that's a pretty steady free cash flow business. Capital expenditures are coming down in the next couple of years. That's going to add to the free cash flow possibilities. So we think as time goes by and as investors get more comfortable with this dividend being sustainable, that 12% yield won't be there anymore, and we think that we'll see some appreciation in the stock, and that'll get us back to a more comfortable 10% dividend yield, which I think is reasonable for this company. And
do you see any risks?
Well, the biggest risks are tied around the dividend. What we've seen is as the Fed bond purchase program, as any kind of, not even that they slow it down, but if there's talks that they slow it down, what the concern is that that's going to make bond yields go up. And as bond yields go up, the high dividend yielding equities become less attractive on a relative basis, given the risk hasn't changed. And so we've seen Windstream and other high yielding dividend stocks in the telecom space get hurt as we hear more and more that the government's going to slow down this program. Now, the flip side of that is that why are they cutting the bond program? Well, because the economy is doing better. So I think for a company like Windstream that has a high yield and is very levered to the economy, if we see economic growth as a result of this, it'll show up in their numbers. And I think the second risk is the second risk really is regulatory. The telecom industry is very regulated, and the rural companies do get a decent amount of cash flow from the government to provide services, telephone and internet services to these rural communities where it's so spaced out and it's very expensive to build. No one would build if the government didn't help them. And some of those programs are being debated and changed right now. So we think 3, 4, 5% of the revenue could be at risk to some of the regulatory changes. But for the grand picture, I think those are probably the two biggest risks.
Great. Thank you so much.
All right. Thank you.
To read the full report on Windstream, please visit our website at www.marketscope.com and come back next Monday to find out the new focus stock of the week.